A return to the office has given some relief to companies that are invested in the commercial property market. One such business is Regional REIT, which reported a swing to a pre-tax profit for the first half of the year. And it also said that the UK's economic activity rebound stemming from an easing of the pandemic's restrictions bodes well for the rest of the year. Let's talk now to Stephen Ingalls, Chief Executive of London Scottish, the asset manager of Regional REIT. Stephen, it's good to be able to catch up with you. How would you describe the return to profit, highlighting the comparison to what I think could well be described as last year's disaster?
Yeah, certainly some challenging times. The simple answer is that the vast majority of companies have continued, despite the difficult times, to trade okay. Our tenants are quality tenants. Our rent collections are 99%. Which I think probably is surprising to many people. Companies are still, on the whole, performing, and the economic activity we've witnessed over the course of the last few weeks, and indeed the return to the office of many workers, bodes well, I think, for the future.
You've also declared a dividend, so there's obviously cash to return to shareholders. Now, I know that REIT status gives a slightly different twist to corporate UK when looking at ways you deal with dividends. Is it not too early to return cash, even under the REIT structure? Are you that confident of the future from here on?
Yes, I mean, we've paid dividends. We paid quarterly dividends, and we paid throughout the pandemic. So our confidence in our income stream was such that we never at any stage thought of withholding dividends. So a continuous dividend stream from us. And that reflects, again, the strength of the tenants that we have and the fact that they have behaved very well on the whole and paid their rents. Clearly, REITs require to distribute a minimum of 90% of their income to their shareholders, and we continue to do that on a quarterly basis. So yield just now on our dividend against current share price is a 7.5% dividend yield, so very attractive to the market.
What sort of tenant do you have? What's their own economic position and outlook? Do you go for a particular sector or some area of the market that you specialise in?
Yeah, I mean, Regional REIT's all about diversification. We are an office specialist REIT. However, we do look at very carefully the makeup of our tenants in terms of their financial strength, but also particularly in terms of the standard industrial classifications, i.e. the industries or part of the economy that they work in. The wider spread of that, the less risk to our income stream. We have roughly 1,000 tenants, so 1,000 individual income streams. And the idea with our approach is that if they derive their income from various other parts of the economy, then any major event, nobody saw a pandemic, but certainly an economic event normally impacts parts of the economy more than others. And therefore, our overall income takes very little damage from an economic or indeed global pandemic hit. I think that's been demonstrated over the course of the last 18 months.
Just looking down some of the quotes, I think you've described the property market as structurally evolving. What do you mean by that?
Yeah, I think even before pandemic, the key issue for the vast majority of companies is the retention of quality staff and attracting new staff. And to do that, you have to offer a much nicer and better working environment. And therefore, your property has to continually evolve to do just that. I mean, if you look at the office market, which is obviously what we specialize in, 2/3 of employees who will be occupying those offices by 2023 will be millennials. Millennials have a very different attitude and outlook to you and I, probably, and therefore you have to continually evolve office to suit the next generation. And that's really what we mean by property and real estate continuing to evolve.
And of course, the other way, I guess, that we've seen things evolve. I mean, COVID clearly has put a different spin on things, but we've also got Brexit to contend with. Has this made a difference, do you think, in anything? Or is Brexit just something that you can sail by and not really have to contend with?
No, I mean, Brexit was overshadowed, obviously, by what's happened with the pandemic. It's still an issue and continues to be an issue, particularly in supply chain situations. it hasn't had the negative impact people anticipated in the office market. And clearly, pre-Brexit, there were all sorts of scaremongering that tens of thousands of jobs would move to Europe and offices in London and elsewhere in the UK, and obviously we specialise in the regions, would be empty. Well, that just hasn't happened. So I think the Brexit situation is still there. It hasn't gone away. There are implications. But actually, I think particularly for the office market, the pandemic has had a bigger impact in the way offices will be used and the potential for hybrid working rather than people being in the office 100% of the time.
So are you changing your investment eye line? I think that's probably the best way to put it, in any way, shape or form, because of what's happened over the last 2 or 3 years, be it Brexit or COVID or whatever. As an investment manager, as I said, you are at the top, and of course you tried to get the optimum return for investors ultimately. Have your horizons changed at all, given all that's happened?
Horizons haven't changed. I think that the way in which we function and the relationship between landlord and tenant has been evolving for some time, but that has been exacerbated by the pandemic. Clearly, people will use offices in a slightly different way, and it's our job as responsible landlords and partners effectively with our tenants to enable them to do so. So we will work with them to change the makeup of their office. I think certainly there will be changes. There will be more collaboration spaces. There'll be more and better facilities offered. And that's really, as I say, to attract people to the office, not only existing staff members, but new staff members. And in an era of effectively full employment, that's vitally important.
Yeah, I just want to bring up a share price chart, if I can, of regional REIT, trading in the London market. See, you can quite clearly see here on this chart, I've drawn it from just before the pandemic hit, where the stock was around about 122. And then all of a sudden, within 2 or 3 weeks or so, 6 weeks, it was all the way down at 51.7 pence at the worst point. Since then, there has been this slow grind up. What does the share price represent in terms of the investments and the value of the investments that you make?
Yeah, I mean, the EPRA NTA at 99.1 pence at the half year, obviously we are trading at a discount to that level. And I think that's probably a structural discount just now, just in terms of uncertainty, not only in the general markets, but also in what the office outlook will ultimately determine. So there is undoubtedly a bit of nervousness. I think as confidence returns and people return to the office, which is happening in large numbers post the end of the school holiday period, I think as that flows through, our share price should see a gradual improvement. The dividend yield is high, and therefore, it's a very attractive stock, particularly to wealth managers and institutions. And therefore, we would expect our share price to recover. As you rightly say, just before the pandemic, we were trading a premium to the NTA. Now we're trading at a small discount, roughly 10%. That will recover in due course.
Just one final question, and this takes us into this second half of the year. How things started, and you talk about the overall picture being underpinning what could be a good result in the second half of the year. Where do you think you will be at the back end of this year? What's going to happen in the next 6 months?
Yeah, I mean, we're almost, obviously late September, so 2021 is only got a quarter to go. But looking at 2022, certainly, I mean, the major influencing parts of our business are supply and demand. We have effectively fixed supply. There's very little in the way of new development happening in our sector, and actually lots of repurposing of buildings for pretty much anything with a bed, whether it be student accommodation, residential, or hotels. So that repurposing, effectively creates a diminishing supply. So call supply fixed. Therefore, it's all about demand. And if indeed you return to the office, which it looks like being just now is a hybrid model, and it certainly looks as if it's going to be Tuesday, Wednesday, and Thursday for the vast majority of companies, then demand will continue because you have all of your staff in the office at the same time, so that they don't need any less space. And I think if you actually take that argument forward to companies having to offer better facilities, you end up with more space for the same number of people offering better facilities. So I think demand will increase. as demand increases, rental growth will flow through. As rental growth flows through, more capital will be attracted to our market, and that will drive capital values. So I'm very optimistic. I think we are going to experience a relatively flat period, being the remainder of this year and into 2022. But towards the end of 2022 and into 2023, I'm very optimistic for the prospects for the regional office market, certainly.
Well, look, Stephen, we hope we'll be able to catch up with you again sometime in that period to get an update from you, and we wish you well. Thank you so much indeed for joining us. That's Stephen Ingalls. He's the Chief Executive of the Asset Manager of Regional REIT. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.